We've been around for over 20 years, adding real estate and private markets 15 years ago after the global financial crisis. We also have invested heavily in our platform. Today we have over 130 private markets professionals. We've deployed over $175 billion across over 30 collateral types over the last 10 years. We've built our business through the lens of one of the leading global fixed income managers. So what does this mean? We have a strong focus on top-down macro insights, which we think is really important across markets. We take a deep relative value investment orientation where we're very discerning about where we find risk and put it in portfolios. And then a very strong view on both risk and capacity management. We also take a long-term view as a lender versus a transactional mindset, which we think is much more aligned to investor outcomes. We also think that coming at this from the broad vantage point of both public and private markets is a key differentiator for our platform. This allows us to access opportunities across the liquidity spectrum and across the capital structure. So we're seeing many more opportunities, and we can place them in the right liquidity and vehicle structures to meet specific client objectives. Also, the things that have been tried and true on the public side, we've implemented in our privates business as well. And that's a focus on data, on scenario analysis, on portfolio implementation and analytics. Our ability to be agile and flexible and to go where we see alpha opportunities is a critical point, and we'll make continued investments in these spaces.
We want to continue to build upon our leadership position in asset-based lending. But there's a collision here of a massive market opportunity created by everything we're seeing from the regional banks and just higher rates in general, putting a lot of pressure on non-bank platforms. With a growing client need that we continue to hear is private credit allocations are becoming larger, they're becoming more structural, but they're not all that diversified. The second focus is being prepared for what we think is going to be some of the most attractive vintages from an opportunistic standpoint. We think we are really well prepared in that real estate and corporate credit are where we feel there's been the greatest complacency over the last decade, where there's been the greatest buildup of leverage, and where there's going to be a lot of challenges among capital structures and stranded assets. At the same time, these are the two areas of the market that we've had a tremendous amount of discipline in our growth over the last decade.